Moody's just downgraded U.S. Treasuries. And guess what? The market didn't even blink. Why? Because the debt's been out of control for years. This downgrade, it's late, political, and investors know it's meaningless. Treasury yields are rising, but not because of a rating. It's about trust, and it's fading fast. Watch the full video to see why ratings agencies are playing the wrong game.
Moving forward, we're going to talk Moody's. They've downgraded U.S. Treasuries. Gary's going to tell us why we don't care at Deep Knowledge Investing. Thing number 2, Moody's U.S. downgrade is meaningless.
Yeah, Rob, I love doing this to you, right? The marketing guys love when I say, here's why what I'm about to tell you doesn't matter at all, right? Terrific.
It's that reverse psychology you're so good at.
Exactly, right? In fact, for those of you, like, if you're short on time, you can just tune out right now. The Moody's downgrade doesn't matter. Just move on, go watch something else. You'll be all set. But if you're still here and you want to like and subscribe, that would be great. We'd appreciate the help. Anyway, Moody's is one of 3 big bond rating agencies. Fitch and S&P Global are the other 2. And this week, Moody's became the last of the 3 to downgrade U.S. Treasuries. They didn't downgrade them a lot, but the highest Moody's rating is AAA, their AAA rating, and they downgraded to the slightly lower AA1 rating. There were lots of hysterical headlines in the press, but the market pretty much shrugged and largely ignored the insult. For once, I agree with the market on this. They got it right. The press was completely wrong. The entire investing world already knows that the U.S. has over $36 trillion of debt. Everybody already knows that interest expense is skyrocketing. It was skyrocketing. It was 600 billion just a couple years ago. I think this year they're looking at something more like 1.5 trillion. It's going to be bigger than our military spending. It's the size of our social security spending at this point. And a lot of people already know there are about $200 trillion of unfunded liabilities. Those are liabilities for programs like Medicare, Medicaid, Social Security. And right now, the Republican-led Congress is in the process of signing off on more multi-trillion-dollar deficits. If you're one of the Democrats, don't take a victory lap yet. The Republicans are just following in the footsteps of the fiscally irresponsible Democrats. Both parties are irresponsible. Team Red spends too much. Team Blue spends too much. Whichever side you're on, we're all voting for people who spend too much. As we keep saying, and as we just said in the prior segment, we cannot vote our way out of our financial problems, and that's why Treasury yields are rising. So the point of all this is the market knows all of this. Everybody who follows finance, even at a basic level, knows this. Moody's downgraded more than a dozen years after one of the other ratings agencies did. I mean, this has just been going on for decades. Doing this now, everybody already knew this. It wasn't news, and the market said we don't care, and that was the right response.
Gary, with everybody knowing about the financial problems the government's had and the U.S. has been going on for years, why now, right? Why did it take Moody's so long to downgrade? Why did they downgrade now?
The timing was suspicious. I think, and many others think, that it was a partisan political move. So just to give you a sense, S&P, Standard & Poor's, downgraded U.S. Treasuries in 2011, so that's 14 years ago. Fitch followed in 2023, 2 years ago. So Moody's is years late, and somehow they managed to do this and deliver the downgrade while Congress was in session debating this year's big spending bill. Like the timing led everybody with a brain to reasonably conclude it was a political shot against the current White House. Which, okay, go ahead, take the shot, but it doesn't change the fact that both parties overspend. It doesn't change the fact that they're going to overspend the dollar into oblivion. And I would just remind people that when Moody's does stuff like this, all it does is weakens their brand. Once people say, I see, you're not really sharp pencil, smart bond people, you're just taking a political shot, then half the country's going to tune out and not pay attention. We'd also remind everybody that all 3 ratings agencies have a conflict-ridden business where they're paid by the companies they rate, One result of that was all three of these rating agencies completely missed on their subprime property loan ratings during the run up to 2008. In other words, who cares what they think? It's a conflict ridden business model. And because of that, they're regularly wrong. Moody's can do whatever in the world they want. Nobody cares. No one's paying attention at this point.
Yeah, and I mean, Gary, with that, I mean, how closely tied to reality is this? I mean, is this a situation where Moody's is saying that the U.S. could technically default? And I'm asking that question for the crowd out there because we obviously know that answer.
Yeah, exactly. So, we did put something in the written version of the five things. I knew, we were going to get some sharp pencil person to say, the U.S. can't default. We print our debt is denominated in dollars. We can create an unlimited number of dollars. Therefore, we can print as many dollars as we need to repay any debt, and therefore we can't default. And guess what? That is technically correct. The bond market is expressing concern that the dollars used to pay those debts will have little value, right? So, for instance, in the prior section, we were talking about the large tail on last week's 20-year Treasury auction. The reason the yield is up so much in the 20 and 30-year Treasuries isn't because people think the US Treasury can't print dollars to pay the debt. The issue is they're worried that over the next 20, 30 years, congressional overspending and dollar printing will lead us to the point where, okay, they'll pay us back, but they're going to pay in dollars that have very little value. Inflation or dollar debasement as a result of seniorage, again, that's just a fancy way of saying the value of being the one who gets to print the money gets to steal from that, right? That's really what seniorage and inflation is. The government prints the money and then they steal from us through inflation. They keep some of that value, right? Remember, when we talk about inflation robbing you of your purchasing power, where does it go? Who gets it? The answer is whoever controls the money first. In this case, it's going to be, congressional spending. It's going to be the banks, the Federal Reserve, the institutions that are closest and can spend the money before inflation comes in. So the point of all this is the U.S. won't default, but it could be a stealth default where, you buy a bond now and in 20 years, they'll pay you back. They'll give you your $1,000. The question is, what can you buy with that $1,000 in
Right.
20 years?
Right. Right. Great stuff there, Gary. And moving forward, this is this week's version of the 5 things to know in investing. The government needs a new credit score issue. We'd love if you subscribe, like, comment. Let us know if you agree, disagree, any questions that you might have on this video. You can also send in questions to ir@deepknowledgeinvesting.com, or you can use the Ask Gary feature on the website as well. And as always, be sure to sign up for a free subscription. You'll get all the written versions of the 5 things on a weekly basis, as well as notified of other content posted on the site. But just so you know, some of that may be paywalled for our premium subscribers who get access to all content, premium content, current recommendations, and the like.